Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields continue the push higher, although we did see a modest pullback towards the end of the session. Yields extended. We got through 2.5%, through 260. Now we're nearing 270. It seems pretty smooth and clean. There hasn't been a massive hiccup that brought the market back or shifted positions. It's been pretty much a straight shoot, and the market continues to lean that way. However, there's always a however in there. We do have some key data tomorrow. GDP, advanced fourth quarter GDP tomorrow, expected to be 3%. That will be the third consecutive quarter of 3% or higher. The last time we saw that, you got to go back about 14 years. So I think that's going to be key. Not that we stay above 3%, but that we see strong growth. We come in at 2.9, 2.8. I don't think the market shrugs it off and turns around. I think what we'll probably see is just slower push higher in those yields. Things may stagnate a little bit, but right now still trending very much towards 275, possibly 3%, depending on what happens not only with the data but with what the Fed says. Those are both big parts of the puzzle. Likewise, what happens to the dollar. So there's a lot of variables up there that you have to question, but certainly the trend is clear, heading higher yields in 10-year. And what has that done to volatility? Well, market volatility, which was anemic in 2017, it started to see a little bit of an uptick as the year began. We did, equities moving higher. We saw gold making big moves higher. We saw oil higher. We saw treasury yields higher. Everything kind of higher. And it took the market by a little bit of a surprise. We did see volatility creeping up, which I think is a necessary thing, especially when you're talking about shifting monetary policy and you're talking about asset reduction from the balance sheet of the Fed. There's a lot of reasons to make things change. And volatility should be a sign of that. Now, we did see volatility pull back modestly today, but that's partially because I think we're staying within that trend of higher yields slowly but surely. But ultimately, I do expect volatility to continue to rise as we enter uncharted territory, that being higher yields and less in Fed involvement. Boy, wouldn't that be a great story? And lastly, let's talk about positioning. The Commitment of Traders reported today that as of January 23rd, the Eurodollar contract here at the CME Group had its highest open interest ever, 14.5 million, exceeding the December 13th print of 14.4 million. You may be asking yourself, why all the interest in 3-month LIBOR contracts? Well, I think obviously a couple of things we want to talk about. A Fed that's changing course, higher rates. This is a very sensitive product to what the Fed does, almost mimicking it. Likewise, we've got a lot of cash in the system, probably more than we have at any time. Likewise, more debt than we have in a long time. So there's a lot of management that needs to be done, a lot of hedging that needs to be done. And we're seeing a lot of different types of strategies to trade here, whether it be outright futures or calendar spreads. And this happens to be the deepest and most liquid contract the CME has. So right now, I think that this is probably a good indication that there's probably going to be a lot more interest, not only in interest rate movement, but also here in interest rates in Eurodollar futures. So right now, new high open interest. We'll look for that, monitor it, and see if it continues as the Fed steps up its game in 2018, possibly taking rates up another 1% possibly by year end. This is Todd Colvin coming to you from the floor of the CME Group.